Hi, this is John Kumarianos. Welcome to a new edition of Capital Considered. Today, I wanted to comment on an article written by a financial planner, Alan Roth, on Morningstar.com. Roth is commenting on the fact that target date funds now have annuity options. A target date fund, as a reminder, is a fund that has a date attached to it. Typically, as an investor, you find it in a 401k, and you try to match the date attached to the fund to your retirement date. And the fund invests in a way that the manager of the fund or the company putting out the fund thinks you should be invested given your age. And so it goes typically from being heavy in stock exposure to heavy in bond exposure as you get older and get closer to your retirement age, 65 for most people. These products are now starting to offer income annuities, and Roth doesn't think they're that attractive, although they may seem so on the surface. So an income annuity is where you give some money to an insurance company and it pays you out some amount for the rest of your life. Based on the payouts, these annuities look like they're paying over 7%, which sounds really attractive. The 10-year U.S. Treasury, for example, if you lend your money to the U.S. government for 10 years, you make about 4.5% right now. So anything over 7 seems attractive. But Roth asks you to contemplate the fact that once you give the money up to the insurance company, what you're getting back is really a combination of interest and principal, because the insurance company can't go out and get 7+%, just like you can't. You have access, believe it or not, to just about the same investments that the insurance company has access to. So that 7.5% is a little bit not fake, but it's a combination of interest and your principal coming back to you. And if you happen not to live very long, you're not getting a lot of your money coming back to you. So you're kind of playing a game where you're betting that you'll live long and you want some guaranteed income no matter how long you live, because that's the way the contract is set up. And the insurance company is betting more that you won't live long and won't have to pay you more than interest and principal. Um, what Roth likes better are TIPS bonds for inflation protection. So that's one of his complaints about these annuities. Yeah, they're paying 7 plus, or it seems like they are, but in addition to principal being included, they don't have inflation protection. Now, you could say maybe they don't need it if they're giving you 7, but inflation's getting higher now. It's now over 4%. So TIPS bonds, we've spoken about them before on this podcast, Treasury inflation protected securities. They are bonds issued by the U.S. Treasury, so they've got the full faith and credit backup of the U.S. Treasury, of the U.S. government. They are tied to the CPI, the Consumer Price Index, so they're tied to inflation. And then the way they're trading now, they're giving you something more. So I've looked at this bond. This is from the St. Louis Fed. This is maturing in 2040. I think it was a 30-year bond when it was first issued. And the way it's trading now, it's giving you something like 2.4% on top of inflation with the provision, if you hold it until maturity. That seems like an awfully good deal to me. These bonds probably shouldn't be held in taxable accounts. They're better held in IRAs, 401ks, any kind of tax advantaged account, because of the way the CPI accrues to the principal of the bond. It's a complicated way of saying the principal of the bond adjusts with the CPI, and you're taxed on that. So better hold it in an IRA. But if you hold this particular bond until maturity, you're getting the full faith and credit of the U.S. Treasury that you'll be paid CPI, and because of the way it's trading now, 2.4% annually on top of CPI. That seems rather impressive to me. And I have a less dim view of these new annuity features that are in target date funds. If you're really concerned about longevity, you're very healthy, you have longevity in your family, you need some peace of mind, some guarantee that some part of your assets are in a product that will guarantee you income, I can see doing it for some modest piece of your money, certainly not all of it, certainly not even half of it. I have a hard time sanctioning that for clients. But some of it, if you need some guaranteed income, I can see the rationale for it. But I do agree with Roth also, although I have a less dim view of these annuity products, I do agree with him that TIPS are awfully attractive. Now, again, provided if you buy a TIPS bond, you hold it until maturity, because they trade in weird ways like other bonds, even though they don't function like other bonds, which is to say they drop in price when inflation shows up, even though they have inflation protection. So before maturity, they trade in kind of funky ways. So I have not as dim a view as Roth does of annuities in target date funds, although I would say use them modestly if you choose to use them. But I do share Roth's brighter view of TIPS bonds right now. So this is John Komarianos for Capital Considered signing off. Thank you for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.